Most investors are trapped in an illusion of control. They think they can outsmart the market, time their entries, pick the winners and avoid the losers. But the truth is, every time you try to beat the market, you're actually falling below average. And if you don't learn why, you'll quietly lose thousands every year without realizing it. Let me paint this picture for you. Imagine every investor in the market sitting around one big table. Some win big and some lose badly. But when you add them all up, what happens? The gains and the losses cancel each other out. That's the zero-sum game of investing. Now let's add one more thing to that table. Fees. Every time someone trades or buys something or sells something, there's a cut for the middlemen, fund managers, brokers, platforms. So even if the total pot balances out, that fee layer tips the scales, which means once the pros take their cut, the average investor now sits below the market average. It's like running a marathon where everyone starts at the same line, but you've got a rucksack full of bricks on your back. Those bricks are fees. I learned this the hard way. Back in my 20s when I was just starting to invest, I thought I'd found a gem, a Warren Buffett style gem, in the form of a glossy brochure fund manager. Through his marketing bump, he promised market-beating returns because he had a strong team of analysts who dove into companies and really understood them to get that leading edge. And he wanted to just charge me 1.5%, just 1.5% for the privilege. After 5 years, when I looked at my investment statement, I realized that he'd made money even if I hadn't. And that's when I really learned something crucial. The higher the fee, the harder the climb. But if active fund managers aren't the answer, then what is? Here's where the index fund comes in. Enter the index fund, the most boring sounding thing in the world that changed my financial life. An index fund doesn't try and pick winners. Yeah, that sounds strange, I know. If you're not investing to pick the winners, then what the hell are you in there for? But that's just the point. You're not in there to pick the winners. You're in there to make money. This is not an adrenaline-filled competition. Boring, steady stuff gets you there. I've said this in other videos and I'm going to say it again, so listen carefully. A business, a company makes money. They're in business to make money. And that includes the companies you want to invest in, of course. These companies have a board of directors. Well, they have a chief executive. They have a board of directors. They have staff. All of them are there to optimize the company, to make more money for the company, to make a profit. Why wouldn't you just want a slice of all of them? An index fund tracks the whole market. The FTSE 100, the S&P 500, a global basket of companies. Whatever it is, there's different indexes. You can pick whichever index you feel like. The thing with indexes, they're simple, mostly automated, and brutally efficient. When I bought one, it almost felt lazy. I thought, surely this can't be it. But what I discovered was the lazier I got with this, the more money I made. Because whilst everyone else was chasing trends, tech one year, healthcare the next, then AI, I just kept buying the market itself. Because everyone in that market is trying to make a profit. All companies are trying to grow. Name me one company that you think is trying to lose money. You can't, because they're all trying to grow. Yes, some may still lose money, but you're not going to be able to pick over any consistent long term the ones that are going to make money and the ones that are going to lose money. So why not just buy all of them and get the average? The other thing with index funds is that the fees are microscopic, the lowest you can get. And because fees are not taking a chunk from my capital, my money could actually compound that much more. And when you look at it, the numbers are shocking, even for small fees like 1.5%. If you invest just £200 for 30 years, and let's say you earn an average of 7% a year on average throughout those 30 years, then you'll end up with about £244,000. But drop that return by just 1% a year, say because of higher fund fees or hidden platform charges, and suddenly you're left with £201,000 a year. That's £43,000 less. It's not 1% of £244,000 or £2,500. You might be able to swallow that, but 1% compounded over 30 years is £43,000. I'll let you figure out what percentage that is. Same market, same risk, same investor. The only difference is fees. That's £43,000 gone. Not because of bad luck, not because the market turned, but because you paid the wrong people too much for doing too little. Every extra percent you pay in fees quietly steals from your future wealth, and it steals years from that wealth. So before chasing returns, check what you're paying, because the difference between 7% and 6% isn't 1%. It could be £43,000 of your life, and I know a number of you are investing way more than £200 a month. Imagine how much it's losing you. The takeaway here is you don't need to beat the market. You just need to stop losing to it. So some of you are asking at this point, if index funds are so good, why isn't everyone doing it? And the answer to that is pretty simple and kind of shocking. And that's because the real enemy isn't Wall Street. Well, it isn't just Wall Street. It's them and you. The financial industry is clever. They know exactly what to say to make you feel like they've got this secret formula. They use sleek, confident language, complex charts. But here's what all of that is actually doing, what they're actually doing. They're preying on your emotions. They sell greed when the market is rising and fear when the market is falling. They know you're confused and will confuse you even more, whilst at the same time trying to make you think that they can deal with all that confusion for you. They know that you're tired of thinking like you're falling behind, and they are brilliant at turning all of that confusion into profit for themselves. And this is because they know the other enemy, the one that helps them, you. When markets fall, fear takes over. When they rise, greed does. We buy high and sell low again and again. Everyone tells us, stay in the market long term, stay in the market. It's easy to think that you will when times are okay, when the market's just plodding along or rising. But when they start to turn, do you question that result? It's the same reason diets fail. We know what to do, but emotion usually wins. I remember during the 2008 financial crisis, I watched my portfolio drop 40% in weeks. Some people I know sold everything. I thought about it too, I'm not gonna lie. And it was because I was scared about losing stuff I'd taken a long time to build up. But I paused and reminded myself, the market always recovers and fear never pays. I held on. A few years later, that same fund, and in fact my entire portfolio, had doubled. And sure, fees are a big cost, as I've just proven, but the biggest cost in investing isn't fees, it's human reaction. The actionable takeaway here is master your behavior before you try to master your investments. In fact, mastering your behavior is a part of mastering your investments. And no one expects you, so you shouldn't either, to become a master overnight of your behaviors or your investments. Just improve day by day, week by week, month by month, and you won't even notice when you've become a master. So how else do you protect yourself from your own psychology? The solution is actually simple but powerful. Build a system that removes you from the equation. And that doesn't mean build technology or build spreadsheets. A system can be as simple as setting up a regular payment to something. My payday routine, and I've done a whole video on it, automatically sends a chunk of my income into index funds every single month. I don't have to decide every month. It just happens. That's one system. And actually thinking about it, it's one of my top systems. One of my most important systems, and actually one of the simplest to put in place. If markets are up, my money buys a bit less. Great. If the markets are down, then my money's buying more of that index fund. Great as well. That's pound cost averaging, the quiet superpower of long-term investing. Yes, it's boring, it's predictable, but it works. Over time, those steady contributions turn volatility into profitability. The actionable takeaway here is automate your investing so your thoughts, your emotions never get a vote. But there is one final trap that people fall into, and it's not emotional or mathematical. It's philosophical. We all want to feel special, right? Nobody likes to be average. So when someone like me says you can get the market average, our ego, and your ego probably at this point, is fighting back. But the irony is in investing, accepting average over the long term actually makes you above average, because most people won't do it. They'll chase hot tips, trade crypto at night, jump into speculative funds, try and buy into the latest hot IPO, and then a few years later wonder why they can't get ahead. Meanwhile, you trundle on, quietly buying the market. Ignore the noise and let time do its work. You don't worry about trends and fads. You concentrate on growing your income, like I said in the last video, or 2 videos ago. Just let the investing take care of itself. And even if you want to take part in all these hot trends and things, allocate 1, 2, 3, 4, 5% of your portfolio for that. But let the other investing just carry on normally, boringly. That's what I did. And years later, when friends who'd been chasing the next big thing compared their portfolio numbers to mine was higher. And I don't say that to boast. I say that to tell you how boring and steady and continuous and consistent gets you there. This wasn't because I was smarter. It was because I kind of stopped trying to be. The takeaway from this is in investing, ego is expensive. Boring takes you towards rich, whatever rich is for you. So what does all that mean for you right now? So here's the full circle. The market average is the best you can do. Not because it's the ceiling, but because it's the foundation. It's the foundation that compounds quietly beneath everyone's chaos. Trying to beat it drains your money and your peace of mind. Accepting it gives you both back. So stop searching for the next big thing. Start owning everything in an index. If you want some element of control, choose an index that's appropriate for you. I choose a bit of emerging markets, a bit of the US S&P 500, a bit of the Indian stock market, but I don't pick individual winners. Start owning everything, simply, consistently, cheaply. That's how ordinary people build extraordinary wealth. And remember, this isn't financial advice. Always do your own research and seek independent guidance before making investment decisions. If you want to understand how to invest without fear or hype, in plain English with practical steps you can actually follow, then hit subscribe on this channel, because financial freedom doesn't come from luck. It comes from educating yourself, upskilling yourself, and the clarity that comes from that. And right now, if you want more, then here's a video chosen for you next.